So imagine two traders.
Okay.
They buy the exact same asset or at the exact same price, and they're using the exact same strategy.
Right, a totally level playing field.
Exactly. They even have the exact same risk limits.
Yeah.
But at the end of the month, one is quietly withdrawing profits, and the other one goes completely broke. Just totally convinced the whole system is rigged against him.
Oh, yeah. It's
Yes.
such a classic scenario.
It really is. So today, on the deep dive, we are figuring out why that happens.
It is a phenomenal premise, honestly. Today we're looking at some incredibly revealing excerpts from a book called The Disciplined Trader, Mastering the Hidden Battle Within.
Yeah.
Specifically, we're diving into this section titled Why Most Traders Never Become Profitable. And it just completely challenges all our baseline assumptions about success in these, highly analytical fields.
Right. Because our mission today is to really uncover that hidden psychological battle. I mean, the text lays out this universal frustration, right? People spend months, honestly, sometimes years, treating the market like it's a giant math equation they just need to solve.
Right, like if they just study hard enough, they'll crack the code.
Exactly. They study price action.
Yeah.
They memorize all those shapes a price chart makes. You know, those little bar formations with the funny names like dojis and hammers.
Oh, yeah, the candlestick patterns.
Yeah, and they think those are supposed to perfectly signal where the market is going. They test dozens of complex technical indicators. And yet, after all that spending, their accounts just keep shrinking.
It's because they constantly look outward for the solution. They assume like, oh, I need a faster news feed or a more complex strategy or some secret indicator used by Wall Street.
Right. Okay, let's unpack this, because why do we always blame our tools when the problem is, well, usually the operator? It reminds me of being on a golf course.
Oh, I love this analogy.
Right. You see a golfer with just a terrible slicing swing, constantly hitting the ball into the woods. And do they spend months working on their stance or their core rotation?
Of course not.
No. They march straight to the pro shop and drop like $500 on a brand new titanium-faced aerodynamic driver because, surely the club was the problem.
What's fascinating here is how the source material basically takes that dynamic and flips conventional wisdom totally on its head.
Yeah.
When a trader loses money, the core problem is, well, it's rarely their intelligence.
Right.
And it is almost never a lack of access to data. The author argues that the fundamental obstacle is actually the trader's own mind. I mean, we go into the market thinking it is this physical enemy we have to outsmart and defeat.
Or going to war.
Exactly. But the market isn't the enemy. The trader's psychology is.
And the text demonstrates this so beautifully with that tale of two traders I mentioned earlier.
Yeah.
So picture two people sitting at their respective desks. They are trading the exact same asset, entering at the same price. And they both follow a strict rule to risk exactly 1% of their total account.
A perfectly controlled experiment right up until the opening bell.
Right. And they both set a stop loss, which, for anyone listening who might not know, is just an automatic safety net designed to sell if the price drops too low.
Yep.
And they also set a take profit, which is a predetermined target to automatically cash out and secure a win.
So the plan is totally set.
Exactly. But almost immediately, the market moves against both of them. The price drops. Let's look at trader number one. He is like staring at the screen, just watching that red candle push lower and lower.
Anxiety is just spiking.
Oh, totally. So he abandons his predetermined plan, overrides his automatic safety net, and he just closes the trade early just to stop the bleeding.
Because he reacts to the immediate emotional pain of the moment, right? Throwing the whole mathematical plan right out the window.
Yes. And then the crazy part is, literally minutes after he closes the trade in a panic, the market reverses.
Oh, of course it does.
It shoots back up and hits exactly what would have been his original take-profit target.
Man, that is the worst feeling.
If he had literally just walked away from his computer, he would have won. So now he feels cheated. He jumps right back into another trade out of pure frustration, not even waiting for his strategy to give him a proper setup.
Revenge trading.
Exactly.
Yeah.
And that one loses too. So now he increases his position size on the next trade because he desperately wants his lost money back.
The spiraling.
Within a span of a few hours, a totally routine trading day has turned into an absolute disaster. By the time the market closes, he's just raging about market manipulation.
Right. And then we have trader number two facing the exact same initial scenario.
Right. The exact same red screen.
Yep.
The market moves against him, His screen shows red.
Hmm.
But trader number 2 had already accepted that losing trades are just a mathematical reality of the business,
Yeah.
before you ever click the buy button.
Wow. Okay.
He doesn't sweat through his shirt staring at the microscopic movements of a 1-minute chart. If the price hits his stop loss, he accepts the 1% loss as just as a standard operational expense.
Just part of doing business.
Exactly. And if it hits his target, fantastic. So at the end of the month, trader number 1 is screaming about manipulation, while trader number 2 is profitable. Same strategy, radically different psychology.
But wait, let me play devil's advocate here for a second.
Go for it.
Couldn't trader number 1 avoid that entire emotional spiral if he just had a slightly better indicator? Like if he had a tool that gave him a slightly earlier warning, he would have more certainty.
Right.
And if he had certainty, the panic just wouldn't exist in the first place, right? And see, that is the ultimate trap. The text attacks that idea head on. Most people believe successful trading starts with learning how to predict the market.
Yeah.
But that is completely backwards. The reality is, the market cannot be predicted with absolute certainty, period.
Not at all.
No one knows where the next candle is going to close. I mean, not the biggest hedge funds with their supercomputers, not the smartest veteran traders, and definitely not the guy selling a $3,000 online course on the internet.
Right.
Prediction is just an illusion.
And, think about how that applies beyond just a price chart, right?
Yeah.
Like, for you listening, how often do you abandon a plan, like a new workout routine or a career goal or a budget, the second things get uncomfortable?
Mm-hmm.
How often do you convince yourself that the system was fundamentally flawed, rather than just admitting you lost your patience? I mean, trader number 1 blamed the system because acknowledging his own lack of discipline was just too painful.
It is entirely an ego defense mechanism.
Right.
Blaming the strategy protects our self-esteem. But if we accept that no one can predict the market, the logical next step is understanding what the market actually is.
Right.
The text strips it down to its absolute core. The market is pure probability.
So it's basically a massive casino, but one where you can actually be the house.
That's a great way to put it. The author uses this analogy of flipping a coin.
Okay.
If you have a perfectly fair coin, every single flip has a 50% chance of landing on heads. That is a fixed mathematical fact.
Right, basic math.
But if you take that fair coin and flip it 100 times, it will not perfectly alternate heads, tails,
You get streaks.
Exactly. You might get 5 heads in a row. You might get a bizarre, agonizing streak of 7 tails. And if you hit 7 tails in a row, it doesn't mean gravity changed.
Or that the coin is broken.
Right. It is simply randomness playing out within a defined probability. And trading works the exact same way. Even the greatest trading strategy in the entire world will inevitably face a streak of losses.
And here's where it gets really interesting, I think, because the way people react to those, mathematically normal streaks of losses is just profoundly human.
Oh, totally.
They treat 3 losses in a row like a driver stuck in traffic.
Yeah.
Have you ever done this? You're in the left lane,
Right.
and it comes to a dead halt.
Oh, yeah. Every morning commute.
Right. So you see the middle lane creeping forward, so you aggressively merge over. But the second you do, the middle lane stops. The left lane starts moving again.
Yep, and then you're stuck.
So you frantically change lanes again. And by constantly trying to outsmart the traffic, you end up moving way slower than if you had just, stayed put in the first place.
And traders do the exact same thing with their strategies.
Exactly. After 3 losses, they change their indicators. After 4 losses, they think, the time frame is wrong, so they switch from the daily chart to the hourly chart. And after 5 losses, they just throw the whole system out and buy another expensive course. They spend years constantly lane hopping, chasing absolute certainty in a system that is inherently uncertain.
If we connect this to the bigger picture, the author actually brings up the parallel of a professional poker player.
Oh, that's a good one.
Right. A professional poker player does not sit down at the table expecting to win every single hand. I mean, that would be absurd.
You'd be laughed out of the casino.
Exactly. They know they can be dealt the absolute best cards like pocket aces. They can play the hand flawlessly. The odds can be heavily in their favor. And they will still lose because the other player got a lucky draw on the river.
Right.
And conversely, a terrible player can hold absolute garbage cards, break every fundamental rule of poker strategy, go all in completely blindly, and actually win the hand.
Wow, yeah. So the outcome doesn't match the skill in the short term.
Exactly. Professionals understand something that beginners just don't. Good decisions do not always create immediate rewards, And bad decisions do not always create immediate punishment.
So the outcome of one single trade or, one single poker hand proves absolutely nothing about the quality of your strategy.
Nothing at all. Success is measured in the aggregate, over hundreds of decisions. But accepting that requires overcoming a massive biological hurdle. We are literally fighting our own neurology.
How so?
Well, think about how basic behavioral conditioning works. If you are training a dog, you give it a treat when it sits. It quickly learns that a specific action yields a specific positive outcome.
Right.
But the market operates on what psychologists call intermittent reinforcement. Sometimes you make a brilliant trade and you get a treat. Sometimes you make that exact same brilliant trade and the market just shocks you with a loss.
Man, that fundamentally breaks our conditioning. I mean, we are meaning-making machines, right? We desperately need cause and effect to make sense of the world.
We do. So if we lose money on a trade, our brain instantly creates a narrative. It says, oh, I made a mistake. My strategy is broken.
Right.
And if we make money, our brain says, I was right. I am an absolute genius. We falsely connect the outcome of a single, completely random event to our decision-making skills.
But the market doesn't care about your narrative or your confidence.
No. It only rewards mathematical consistency over time.
Conceptually, that makes total sense. I mean, if you know trading is just a game of probability, why is it so overwhelmingly hard to just follow the math?
That's the million-dollar question.
Right. And the text uses this really brilliant thought experiment to expose how our logic gets completely hijacked. So imagine a game where the rules are really simple. Every time you play, you have a solid 60% chance of winning $100 and a 40% chance of losing $50.
Okay, let's break down the expected value of that game.
Yeah, let's hear the math.
If you play it 100 times, the math dictates you will win 60 of those rounds for $100 each. That's $6,000.
Okay.
You will lose 40 rounds for $50 each. That's $2,000. So 6,000 minus 2,000 leaves you with a pure statistical profit of $4,000.
Wow.
Every single person on Earth should play that game until their fingers bleed.
The math is heavily, heavily in your favor. But the text asks us to imagine that you sit down to play and you lose the first 4 rounds.
Because randomness happens.
Exactly. You hit that 40% chance 4 times in a row. You are now down $200. Suddenly, the player panics. They begin doubting the game. They think the dealer's cheating. And most importantly, they stand up and stop playing.
Yeah, they tap out.
But mathematically, absolutely nothing about the game changed. The 60% edge still exists in the very next round. Their fear simply convinced them it disappeared.
And the answer to why we do this takes us straight into evolutionary psychology.
But wait, isn't fear a really crucial survival tool? I mean, from an evolutionary standpoint, fear is the mechanism that kept our ancestors from getting eaten by saber-toothed tigers, right?
Yes, absolutely.
If you heard a rustle in the bushes, the humans who felt fear and ran away, well, they survived. Shouldn't that same survival instinct keep our bank accounts safe?
You would think so, but the stock market isn't a tiger, and the problem is your amygdala doesn't know the difference. Let's look at the physiology of what happens when a trade goes into the red. You are staring at a screen, and the price drops past your safety net. Your brain doesn't just register a mathematical miscalculation.
Right.
It registers a loss of resources. And in evolutionary terms, a loss of resources means starvation, and starvation means death.
Wow. So it's that extreme.
It is. Your heart rate spikes, cortisol floods your system, you are thrust into a literal fight-or-flight response while just sitting in an ergonomic office chair.
So that physical panic basically forces us to do the exact opposite of what logic dictates.
It makes us wildly irrational. Think about it. When a trade is winning and in profit, fear whispers that someone is going to steal your food, so you close the trade way too early just to secure the scraps.
Oh, wow. You leave a massive amount of money on the table.
Exactly. But when a trade is losing, when that red line is dropping fast, instead of fleeing the threat, fear actually paralyzes you. You hold on to the losing trade, just hoping the predator wanders away.
Yeah, you just freeze.
We cut our profits short, and we fiercely protect our losses, letting them grow bigger and bigger.
We become hopeful when we should be fearful, and fearful when we should be hopeful. That's wild.
It really is.
And fear is only half of this evolutionary trap, right?
Yeah.
Because the text immediately pivots to the other side of the emotional coin, which is greed.
Oh, yeah. The other monster.
Let's say you actually manage to ignore the fear for a bit, and you catch a nice winning streak. Your brain's reward centers just light up. You feel euphoric. And instead of sticking to your strict 1% risk management, greed takes the wheel.
Because you feel invincible. You convince yourself that you haven't just gotten lucky. You have finally figured the market out. You have unlocked the matrix.
Right, so you double or triple your position size on the next trade.
Right.
And that is when the market does what it always does. It makes one random, unexpected move.
Always.
Because your position size was entirely too big, that one single move erases weeks or even months of slow, steady progress. It's just an exhausting, endless emotional loop. You feel fear and panic after taking losses. That leads to revenge, trading out of frustration. Eventually, you hit a lucky streak and feel immense euphoria, which leads to greed, oversized risk, and eventually a massive loss, which throws you right back into fear.
You are not actually fighting the market. You are locked in a cage match with your own biology.
So, what does this all mean? How do we actually break the loop?
Yeah, the text drops this ultimate twist here, and it requires a really profound shift in perspective. The grand realization that frees a trader from this cycle is simply this: the market doesn't care.
At all.
It is entirely indifferent to your existence.
Right. It doesn't know where you entered your trade. It doesn't know where you placed your stop loss. It doesn't care that you had a terrible morning. And it certainly doesn't know that you are desperately trying to recover the money you lost yesterday.
It has no memory.
Exactly. The market is just a massive ocean of collective human behavior. It simply moves.
This raises an important question, though. If the market is this unfeeling, uncontrollable force of nature, what is actually in your control? The author argues the answer is absolute, total responsibility. And honestly, that is a heavy burden.
Yeah, it's easier to point fingers.
Right. Think about the comfort of blaming a broken tool or a manipulated market. If it is the market's fault you lost money, you are a victim. And victims don't have to change their behavior.
Wow, that's powerful.
But if your emotional reaction to the market's movements is entirely your own responsibility, there is nowhere left to hide. The panic, the greed, the urge to revenge trade, that's all generated internally.
So once you truly accept that the market owes you nothing, and you stop trying to control or predict it, you are finally free to focus on the one and only thing you actually can control: your own decisions.
Executing your plan flawlessly, managing your risks strictly, accepting the probabilistic outcomes without emotional attachment, that is where real, lasting consistency begins. Not in predicting the next candle, but in mastering yourself.
That is beautifully said. And as we wrap up today's deep dive, I want you listening to just zoom out a bit and think about the probability game of your own life. Because this concept applies far beyond a financial chart. Where else are you abandoning a perfectly sound strategy? Maybe it's the trajectory of your career or those new health habits you're trying to build, or even how you communicate in your relationships just because you've hit a statistically normal random streak of bad flips.
Yeah, that's the real question.
Are you letting an ancient evolutionary fear of a saber-toothed tiger disguise itself as modern intuition? It's really worth asking yourself whether your life system is actually broken, or if you just need to trust the math, manage your emotions, and keep playing your edge. Keep diving deep, keep questioning your own assumptions, and we'll see you next time.